Welcome back to our 9th lesson of Chapter 6. Today, we will be demystifying the concept of margin call in Forex trading. In the world of Forex trading, there's a term that can sometimes send a shiver down a trader's spine: margin call. It's a critical concept that plays a pivotal role in trading, and understanding it can make a significant difference in your trading journey. To begin unraveling this concept, we'll start by defining what a margin call level is. The margin call level is a threshold set by brokers. It's like a warning bell, indicating when your trading activities might be at risk due to a drop in the margin level. Think of it as a safety net of sorts, designed to protect both the trader and the broker from severe losses. Next, we'll delve into the difference between margin level and margin call level. While they might sound similar, they serve different purposes in Forex trading. The margin level is a real-time indicator of your equity versus your used margin, while the margin call level is a specific threshold that, when reached, triggers a margin call. We'll then walk you through the margin call process. This process can be a bit daunting, as trading on margin can lead to a margin call if losses reduce your equity to a critical level. But don't worry, we'll guide you through it step by step. We'll also discuss the various methods of notification when a margin call is triggered. In the olden days, it used to be a phone call. Now, it's usually an automated system. Then we'll illustrate scenarios where significant floating losses lead to a margin call. This will help you recognize potential triggers and hopefully avoid them. We'll cover the potential actions a broker may take upon reaching a margin call, like requiring additional funds or closing positions. And lastly, we'll highlight the importance of a swift and effective response to a margin call to prevent further losses or position closures. By the end of this video, you'll have a comprehensive understanding of the margin call process. So, let's dive in, shall we? Firstly, let's clarify what we mean by margin call level. It's a term that might sound intimidating, but its essence is quite straightforward. It's essentially a line in the sand, a threshold set by your broker, that signals when your trading activities may be at risk. To paint a clearer picture, think of it as a safety net. It's there to prevent you from falling into a financial pitfall. Brokers set this level to safeguard both your interests and theirs. It's like a warning bell that rings when your margin level drops to a certain point, indicating that your open positions are at risk of being closed due to insufficient funds. Now, how is this level determined? Well, it largely depends on your broker's policy and the terms of your trading agreement. Some brokers might set the margin call level at 40%, others at 20% or even lower. Remember, this margin call level isn't just a random number. It's based on the ratio of your total equity to the used margin, multiplied by 100. So, if your total equity is $10,000 and you've used $5,000 as margin for your trades, your margin level is 200%. If this level drops to the margin call level set by your broker, it's time to take action. The margin call level is your broker's way of saying, hey, you're running low on funds, your open positions are at risk. It's a wake-up call, urging you to either deposit more funds into your account or close some of your open positions to restore your margin level. In essence, the margin call level serves as a vital financial health indicator in your Forex trading journey. It's a tool that helps you manage your risk, keeping you informed about your financial standing and helping you make informed decisions to protect your trading capital. So the margin call level is a crucial indicator of when your trading activities might be in jeopardy. It's your financial compass, steering you clear of potential trading pitfalls and guiding you towards more secure trading waters. Now let's differentiate between margin level and margin call level. Margin level and margin call level are terms that often trip up newcomers to Forex trading. They sound similar, but they serve distinct roles, and understanding the difference is vital to successful trading. First, let's talk about margin level. Think of it as a real-time gauge of your account's health. It's calculated by comparing your equity, that's the total value of your account, including any open trades, with the margin you've used to open those trades. It's expressed as a percentage, and the higher the percentage, the more breathing room you have. Margin level is dynamic. It fluctuates as the prices of your open trades change, and it can give you a sense of how close you are to a potential margin call. But remember, it's not a warning light. It's just an indicator. Now, on to the margin call level. This is a predetermined threshold set by your broker. If your margin level drops to this point, it triggers a margin call. In other words, it's the point at which your broker says, hey, your trades are at risk. You need to do something about it. Unlike the margin level, the margin call level is static. It doesn't change with the ebb and flow of the market. It's like a line in the sand drawn by your broker, and crossing it can have serious consequences for your trades. So in summary, the margin level is a real-time indicator of your account's health. It's a percentage that tells you how much of your equity is tied up in open trades. The margin call level, on the other hand, is a preset threshold. If your margin level hits this point, it triggers a margin call, signaling that your trading activities are at risk. In essence, while they might seem similar, margin level and margin call level play different roles in the trading process. Moving on, we'll delve into the margin call process itself. The margin call is a critical aspect of Forex trading, particularly when trading on margin. Let's envisage a scenario where you are trading on margin. You have borrowed funds to make larger trades, hoping for larger profits. However, as is the nature of trading, things don't always go as planned. Perhaps the market takes an unexpected turn, and your positions start to incur losses. These losses begin to eat into your equity, the total value of your account, including your open trades. As the losses grow, your equity reduces, and so does your margin level. Now, the margin level is a real-time indicator of your account's health. It's calculated as the ratio of your equity to the used margin. In essence, it shows how much of your used margin your equity can cover. So when your losses reduce your equity to a point where it can no longer cover a certain percentage of the used margin, you hit what we call the margin call level. This is a critical threshold set by your broker, and crossing it triggers a margin call. And what is a margin call? It's essentially a warning, a signal that your trading activities are at risk. It's your broker telling you that your account doesn't have enough equity to sustain the open positions. At this point, you have to make a decision. You can either add more funds to your account to restore the margin level, or you can close some of your losing positions to reduce the used margin. If you ignore the margin call and your losses continue to mount, your margin level could drop even further. If it hits the stop-out level, another threshold set by your broker may start closing your positions automatically, starting with the most unprofitable ones. Therefore, understanding the margin call process is vital to managing your risk when trading on margin. How are traders informed about margin calls, you ask? Well, traditionally, brokers would reach out to traders by phone to let them know they were close to or at a margin call. It was a personal, albeit sometimes stressful, way of doing things. However, as technology advanced, so did the methods of notification. Today, many brokers use automated systems to keep traders in the loop. This could be in the form of email alerts, text messages, or notifications on trading platforms. Some even use a combination of these methods to ensure that traders receive critical margin call alerts in a timely manner. These modern methods are not only faster but also more efficient, eliminating the risk of human error. They allow traders to react swiftly, potentially saving them from substantial losses. So, it's important to stay alert and be aware of the communication methods your broker uses to notify you about margin calls. Now let's look at some scenarios that can trigger a margin call. Imagine you're a Forex trader and you've opened a position in the EUR-USD pair. You've done your homework and have placed a bet that the euro will rise against the US dollar. You've committed a substantial portion of your account to this trade, seeing it as a sure thing. But then, out of the blue, a major economic report comes out, showing unexpected strength in the US economy. The dollar surges and the euro falls. Suddenly your trade is underwater, your equity in the account is falling, and it's falling fast. It reaches a point where it's no longer sufficient to cover the required margin for your open positions. This, my friend, is a classic trigger for a margin call. Now let's consider another scenario. You have multiple trades open, spreading your risk across various currency pairs. But then, a geopolitical event occurs. Let's say there's a sudden escalation in tensions between two major world powers. The Forex market reacts to this news, and volatility spikes. Several of your trades start moving against you at once. Your account equity starts to dwindle, and once again, you're staring down the barrel of a potential margin call. Or perhaps you're a high-frequency trader making dozens or even hundreds of trades a day. You're making small profits on each trade, but then you hit a losing streak. Trade after trade goes against you. Even though the losses on each trade might be small, they start to add up. And if you're trading with high leverage, those losses can eat into your equity very quickly, potentially triggering a margin call. These are just a few examples, but they illustrate the point. Whether it's a single large trade going wrong, multiple trades moving against you simultaneously, or a series of smaller losses adding up. Any of these scenarios can lead to a margin call. These examples should give you a clear idea of situations that can trigger a margin call. What happens when a margin call is triggered? Let's dive into the aftermath of this crucial event in Forex trading. A margin call is a wake-up call, a signal that your trading account needs immediate attention. So what's next? Once a margin call is triggered, your broker has a variety of potential actions that they can take. These actions are typically outlined in the terms and conditions of your trading agreement, so it's important to be familiar with these details. One common response is the requirement for additional funds. Your broker might request that you deposit more money into your account to cover the margin requirement and get your margin level back up to an acceptable level. This is like a lifeline, giving you the opportunity to keep your positions open and continue trading. However, if you're unable to meet this requirement, or if the market continues to move against your positions, the broker might take more drastic action. One such action is the forced closure of positions. This is often referred to as a stop out. In this scenario, the broker starts closing your losing positions to prevent further losses and to bring your account back to a healthy state. This is usually done starting with the most unprofitable positions. It's important to remember that such actions are not arbitrary or punitive. They are protective measures designed to prevent your account balance from falling into negative territory, which could leave you owing money to your broker. In the world of Forex trading, the phrase, "cut your losses," is often quite literal. But it's not all doom and gloom. A margin call can also serve as a learning opportunity. It can help you understand the importance of risk management, encourage you to reassess your trading strategy, and remind you to keep a close eye on your account balance and margin levels. As you can see, a margin call can have significant implications for your trading activities. It's a pivotal moment that enforces discipline, demands quick action, and ultimately shapes how you navigate the unpredictable waters of Forex trading. Finally, let's talk about the importance of taking timely action in response to a margin call. In the world of Forex trading, every second counts. When a margin call is triggered, it's a clear signal that your trading activities are at risk. The clock starts ticking, and the consequences of inaction can be severe. Imagine a sinking ship. The margin call is your distress signal, alerting you that your vessel, your investment, is in danger. Ignoring this signal could lead to further losses, even the closure of your positions. Swift and decisive action is your lifeboat, a chance to minimize losses and protect your investment. You could add more funds to your account, reducing the risk, or close some positions to free up some margin. Remember, the goal is to prevent your equity from sinking further. Remember, time is of the essence when dealing with a margin call. And that brings us to the end of our lesson on margin calls. We've journeyed through the intricacies of this vital concept, starting from the definition of the margin call level, set by brokers to indicate when trading activities may be at risk. We then differentiated between the margin level and the margin call level, shedding light on their unique roles in trading. We dove into the margin call process, discussing how trading on margin can lead to a margin call if losses reduce equity to a critical level. We explored how traders are informed about margin calls and illustrated scenarios that can trigger a margin call. We also covered the possible outcomes of a margin call and stressed the importance of timely action to mitigate further losses. Now, we encourage you to complete this lesson, digest this newfound knowledge, and prepare yourself for the next exciting topic, the stop-out level in Forex trading. Thanks for joining us today. We look forward to guiding you through the stop-out level in Forex trading in our next lesson. Until then, happy trading.